Good evening, everyone. We are here for our Baumer evening conversation at the Knowlton School with Dan Immergluck of Georgia State University. Dan is an expert whose research focuses on affordable housing, housing policy, fair housing, community development, and also housing finance, and a variety of other topics. Happy to have this conversation with Dan tonight on the impact of COVID on the housing market, as we will engage the topic of trauma and transformation of the housing market in the aftermath of COVID. With that, I want to give Dan an opportunity to say hi to everyone, and then we will transition into his presentation, followed by a moderated discussion afterwards. Also to note that we have a chat box open on our stream on YouTube, so please share some of your questions there for Dan for the conversation tonight. Thank you, and with that, Dan, give you an opportunity to say hello to everyone.
Thank you, Jason. I just want to start by thanking Jason, thanking Jennifer Clark for inviting me originally to visit Columbus. I haven't been to Columbus in quite a while. I spent a couple of years in Columbus about 30 years ago, and I worked for the state of Ohio, but I'm really happy to be here. I'm also want to thank Eric Herman for kind of doing all the logistics, and Yaz Motoyama for participating tonight. As Jason said, I'm here to talk about what I call crisis on top of crisis. And I'm, got a limited amount of time. I'm going to throw a bit of data at you, hopefully not too much, but I want to have some content, and I'm going to close with some policy suggestions and policy concerns, some of which I think have gotten some attention, but others I think have gotten too little attention. I'm going to share some slides here. Hopefully those are, looks like they're working. The first crisis, of course, is the pandemic crisis, and that's on top of a pre-existing affordable. Who are tuning in tonight are familiar with that. And the question is, what's in the press deservedly is the very real concerns about folks losing their homes, folks being evicted, folks struggling to deal with arrearages in rent because they've lost jobs or lost incomes, and the kind of short-term policy responses to that. There are lots of sources for that. I'd really, point folks to the National Low Income Housing Coalition as really the key source for keeping track of that. But I also want to really look a little bit ahead and at other issues that spill out of these problems. So if I can get this to, there we go. So again, some short-term impacts, some short-term policy response discussion, but a little bit more attention to potential longer-term impacts, particularly on the supply of low-cost, affordable rental housing, not just subsidized housing, but what some folks call naturally occurring housing, what I tend to call older, low-cost rental housing, and a set of policy implications that's stemming from these trends and these concerns. I'm also going to push back a little bit on some of the things that appear almost daily in the media about what COVID might mean for cities, for housing. I think some of them are overblown. Some of them are real kind of purely speculation at this point, and some of them really don't have much kind of evidence behind them at this point. But let me start with the notion that this is a crisis more than the Great Recession. Even though the Great Recession hurt some communities much harder than others, this one has really hit low-wage workers the hardest, very clearly. This is from the folks at the Opportunity Insights Group at Harvard that shows not only were low-wage workers hit harder in terms of job loss, seeing employment go down by more than 30% very quickly, but the rebound has been much weaker for low-wage workers. And as many of the layoffs that hit higher wage workers were temporary. Folks have either found other jobs or been called back. The low-wage workers often haven't been, and those job losses are starting to become more permanent. And given that we have, really don't have a sustainable response to that from the federal government, we had a short-term response in terms of the CARES Act and the expanded unemployment insurance, but what's been done lately will expire very quickly, and we're really dealing with people who already were suffering from housing affordability issues, really put in a much more difficult position. So one of the things that bugs me quite a bit from the media is for the first 3 to 4 months of the crisis, and even still, we continued to hear that there was no real issue with evictions or with people having trouble paying rent, and they would continue to cite one survey, and I still see it cited almost every week, that showed that rental properties really weren't having trouble collecting rent. Well, the problem is this one survey from a group called the Multifamily Housing Council is a survey of predominantly corporate landlords and property managers, of predominantly what is called Class A rental buildings, which serve predominantly middle and even increasingly upper middle income and upper income tenants. What we saw in the wake of the foreclosure crisis is more middle and upper income people renting. And so we saw in cities like Atlanta and New York and other cities a big surge in luxury apartment building construction. And those buildings are really doing pretty well because those folks are mostly working from home or able to. And it turns out that they're still collecting about 80 to 85% of their rent by halfway through the month. The problem is with these older, lower cost rental units in older buildings, usually more than 30 years old. This is where most of the affordable rental housing in the country resides. Most of the affordable housing in this country is not government subsidized. It's just old, lower quality housing that is sometimes located in places that aren't ideal and often is to some degree a little bit under-maintained. But that is providing affordable rental housing. And what that data shows on this slide is that there has been a big drop-off in rental collections. Typically, like you did see in January through March of this year, you're talking about 80% of the rent roll being collected by the middle of the month. That fell to the 60s in April and May, and then it fell to the 50s, and by July, it was below 40%. Some of these people are not getting unemployment. We're not getting the extended unemployment because that didn't cover everybody, especially undocumented folks, but also some other folks. Some folks, like especially in my state of Georgia, were waiting months to get their unemployment checks, so they weren't able to pay. So we did see a lot of damage to the rental market from the crisis. And what I'm going to argue is a lot of these buildings are owned by smaller landlords. Some of them are owned by corporate landlords, but a good number are owned by smaller landlords who really don't have the financial reserves that a large corporate landlord has. And so there's some real concern that we're going to lose this housing. It's not the best housing, but it's what people have. And if we lose it, what are they going to have? That's a real concern. What they're going to have to do is double up. Not something you really want to be happening in the middle of a pandemic. This slide comes from another recent study by the Urban Institute, and it doesn't look at age of property, although there's some correlation between age and size, but it looks at size of rental properties. And what it finds is that tenants in smaller buildings are more likely to be Black or Latinx or Latinx than tenants in larger buildings. And this is partly because the larger buildings are more likely to be more expensive and newer properties and Class A properties. Not all of them. There are old, large properties, but a lot of the 2 to 4 unit rental units, a lot of the 30 unit properties in cities like Chicago and Boston and New York are quite old. And those tend to be the more affordable properties where a lot of folks of color rent. So this is a real concern. It's also the case that the smaller buildings, especially the 2 to 4 units, are, number one, tend to be owned much more by small landlords. A lot of what we call ma and pa landlords, that's an old term. Yes, there certainly are corporate landlords increasingly in the small building space, but well over 2/3 of small rental properties are owned by small landlords. And that's really true for the kind of mid-sized properties too. Well, these owners do not have lots of financial resources. They have more than the tenants, no doubt about that in general. But after 6 months of folks not being able to pay, we're going to see some of these properties either, one, go into foreclosure. We've seen some of this, at least anecdotally. Number two, the big landlords will come and pick and choose to acquire some of these distressed properties. And what will they do to them? Most likely either knock them down and build high-end rental where the market is still stronger, or renovate and basically create Class A property out of renovation. The other thing that will happen, and I think this is, given I'm talking at Ohio State, relevant to a good number of places in Ohio, in weaker market cities, cities like Cleveland, cities like Dayton, I fear that we could see a lot of these properties just basically abandoned. They may be foreclosed upon. I know in Ohio during the foreclosure crisis, we saw a good number of lenders just walk away from properties rather than complete foreclosures. That's a possibility. Who wants to foreclose on an apartment building when they don't think they can sell it? So we may see, my fear is we see properties being lost at the top end by kind of upgrading, gentrification, those kinds of pressures, because there's still going to be demand, I think, for high-end rental housing. And then we're going to see properties dropping out of the bottom end. And which of those processes dominate depends on the market, really, the local market. And so there's an opportunity here later, I'll talk about, for policy to intervene here and try to capture some of these properties for long-term affordable housing. This is another slide from the Urban Institute, which does a lot of things at once, but I think it does it fairly efficiently. On the left-hand side is concerns about housing costs by renters, and on the right-hand side is concerns about housing costs by homeowners. And what you see is, first, mortgage folks who own their homes with a mortgage are suffering less anxiety about being able to keep their home. And I'll talk about why that is and what that means for policy. But in both cases, Black and Latinx tenants and owners are suffering more stress on housing costs and more worried about rent and mortgages than whites, than owners. And in fact, it's such a big difference that white tenants have fewer concerns than Black and Latinx homeowners, right? Even though, homeowners are generally in a better position. Well, one thing is the distance between Black and Latinx renters is partly what I'm talking about in this, in the job picture, who's been laid off, who's lost their jobs, right? But it's also partly reflective of the segmentation of the rental market. Is whites are disproportionately tenants in the Class A properties. Black and Latinx families are disproportionately tenants in the Class C properties. It doesn't mean they don't, it's not perfectly segmented by any means, but it's not just that these older properties are in danger, it's that the tenants are in danger, and the tenants are folks of color disproportionately. This slide, I just wanted to bring it up because it affects the housing market. We found out it affects the housing market a lot during the Great Recession, and that was a slowdown or reversal in household formation, in kids, kind of young people starting their own household. And a good measure of this is the percent of young adults who live with their parents. What we've seen historically is that after World War II, that number really plummeted because of, the GI Bill and what folks now call white affirmative action. There was all kinds of government support for basically creating new households, FHA mortgages, suburbanization, and lots of economic support by the expansion of the middle class. Right. And so we hit this kind of bottom point in the 80s of this. And then what happened? What happened was, for lack of a better term, neoliberalism, meaning we had stagnant wages and rising rents for decades. And what that means is folks, live with their parents because, especially in higher cost markets, it's just too expensive, especially when wages aren't rising and rents are rising, right? So that created this pretty steep slope upward, and it increased during the Great Recession. And then we hit pretty much the all-time high around 47, 48%. And then the pandemic hit. And some people say this measure is probably undercounting the increase. I know from personal experience, I have an older daughter who is now at home, and I know lots of folks do. But we saw at least a 5 percentage point increase in the number of young adults who are now living with their parents. And that means that the potential good part of that can be a little bit less demand on the rental market. And that could be good, but in the long run, that's going to probably change. I don't see this as I think we're going to come back down. I don't think, also speaking from personal experience, I think my daughter will be out of the house as soon as she can be. Let's put it that way. At the same time, we've seen in another key metric, which is how easy it is to get a home loan, to buy a house. And that's this mortgage credit availability index. And what we saw during the foreclosure crisis and the Great Recession is that number plummeted. It was too high during the subprime boom, meaning it was too easy to get a mortgage. But the number went down very low starting in about 2009, and it stayed low through 2012. And finally, it started creeping up somewhat slowly from 2012 to about 2018, and then has been kind of flat until the pandemic. And now we've seen the sudden drop in mortgage availability. And my concern is these drops tend to hit folks of color much harder. It basically is an issue of disparate impact in terms of fair housing. When mortgages get harder to get, the people who are shut out of the market, out of the home buying market, tend to be disproportionately Black and Latinx folks. And that's not a good thing. And that will also put I said, well, there'll be less pressure of young people coming into the rental market, but generally there's a flow out of the rental market into homeownership. This could shut that down to some degree and keep pressure on the rental market, which really isn't a good thing for rents in terms of keeping rents modified. So it's a concern both for people not to be able to buy homes and gain wealth, and for racial wealth disparities, which, basically what we should have done during the Great Recession is really made sure to get this index up sooner so that folks could buy homes when prices were low. Instead, it took so long. By the time more Black families in particular could buy houses, prices were higher, and that has eroded some of the wealth generating ability of homeownership. Now, let me beat on the media some more. One reason for this problem in this particular case is because our media is national media is heavily concentrated on the East Coast, particularly out of New York and DC. And, I picked national media, but when I went to look for local stories outside of New York and San Francisco about people fleeing to the suburbs, I couldn't find any. It's kind of like the local media weren't fooled by this, because maybe they know their real estate markets better than to make suggestions that everyone's leaving to the suburbs. Well, it is true that there is evidence that inventory in Central City, New York, and Central City, San Francisco surged during the pandemic, and demand for suburban locations increased. Well, these are, arguably the two most affluent cities in the country, two of the most affluent cities in the world in terms of numbers of affluent people. And those people had the option to move, maybe to buy a second house, right? And maybe the move is not permanent. Maybe they're moving out for whatever reason and then going to come back. So, I'm skeptical of the permanence of this, but there is really little evidence that this is a problem that's affecting more than those two metropolitan areas. And I'll go over some evidence on this. The best evidence for why I think this isn't happening is from the real estate company Zillow. Zillow, as you may know, has pretty much data on almost every home sale in the country. And they collect it and they analyze it. And what they did is they created median appreciation numbers by zip code and weighted them, and then broke zip codes into two groups, urban and suburban. And they said, well, if everyone's fleeing to the suburbs, home prices should start accelerating in the suburbs and drop in the cities. And they didn't find that. Now, the y-axis here is year over year price growth, right? So during this whole period, homes continued to appreciate. And interestingly, after the pandemic, homes appreciated more, a little bit more, not a lot more. 3.5% to 4.1%, 3.25% to 4.3%. But the increase over this time is greater in cities than it is in suburbs. And there is no clear inflection point here that correlates to the pandemic, which would have been about March, right? Between March and April, the lines are very smooth. There's a little bit of, asymptote going on the urban curve, but nothing. Urban is still appreciating faster than suburban. There's nothing here that suggests that people are fleeing cities and going to suburbs. Now, a recent couple weeks ago, a group that I think is hardly unbiased, which is the National Association of Home Builders, released a little blog saying, oh, home building's going crazy in low density counties, kind of exurban, low density suburbs. Well, I looked at it and I'm like, really? I'm not seeing it. And let me explain it. This is about building permit family home construction. So that's already a clue, right? Single family tends to favor the suburbs. But they looked at low density market's share of single family construction. So the y-axis on the left is that share, and it's the blue bars. And you see is it doesn't change much because they did this gimmick where you don't make the y-axis change very much, and it looks like a lot of change, right? So a lot of my friends, data visualization friends, would scream at this y-axis. So you're talking about a range from 47% to 48.4%. This is not a lot of change. The maroon bar or the maroon line is actually a better measure. And I don't want to get into the mechanics of how it's calculated, but I think it's a better measure of year over year change in share. And, when I looked at it, okay, when I got this, the dashed red line wasn't there. I put that on there. I looked at it and I don't see it. I don't see all of a sudden a sharp discontinuity in the last bar. There is a little bit of upward slope, but what I see is one, a general upward trend in that maroon line from the beginning of the graph to the end of the graph. And then what I see is a pretty strong upward slope from Q2 of 2019 to Q2 of 2020. And to me, that says there is some increased gradient towards the suburbs, meaning building is moving towards the suburbs a little bit. But it started well before COVID. COVID is way over to the right. So I don't, my hypothesis, and it's, I think, somewhat informed, is, this is after a 8-year run up in housing values, and builders are running out of land. So they're moving farther out because they can't build for affordable prices closer in, or at least they think they can't build. And there's evidence that they're finally starting to build a little bit more, I wouldn't call it affordable housing, but kind of mid-priced housing instead of just building luxury housing. And that they need to go farther out for because they need the cheaper land, especially if they're going to build the traditional half-acre lot kinds of single-family homes that they still seem to prefer to build. So I don't see the evidence. This is back to the Zillow paper, and they did, I like this paper because they said, look there's at least one city we found, they didn't look at New York specifically, where there does seem to be an excess of inventory in the city compared to the suburb. And that's what the solid line on San Francisco spiking up means. Basically, inventory doubled in a very short period of time. Of course, inventory in San Francisco has always been very low. So doubling a small number may not be that big in terms of raw numbers. So I think that adds to it. But the other graphs basically show that the city and suburb are tracking each other, and that inventory hasn't gone up a lot. It hasn't gone down a ton. But if anything, inventory in both cities and suburbs has been going down during the pandemic. And I think that's partly due to low interest rates. Middle and upper income people are buying homes, people who have good credit and can get the mortgages because interest rates are very low. It's a smart, it makes it so that you can buy a bigger house, basically. I wanted the last couple of slides before I go into the policy stuff really are about this naturally occurring affordable housing. Again, I prefer older, lower cost rental housing. And CoStar did this study about 4 years ago. It's a big real estate company, data company, where they categorized every rental property in their data set, which is huge. And they called 1-star and 2-star, these are mostly over 40 years old rental properties, this kind of naturally occurring affordable housing. And then they looked at how much of it there was. And they're basically, this is my own pie charts, but it's from their data. And basically we're talking about 44 million rental units in the US. Notably, more than half are 1 to 4 unit rentals. So I'm not even talking about that right now, because there's a lot of low cost rental housing in the single family space, which we should be concerned about too, because those landlords tend to be very small on average. But just in the multifamily space, there's about 16 million unsubsidized multifamily buildings, and over a third of those, almost 6 million at least, I think this is a conservative estimate, are these older, lower cost units. That's almost twice the number of subsidized units in the whole country. So we spend a lot of time talking about creating and preserving subsidized rental. And I understand that. It's great because it's rent restricted and income restricted. So the folks who need it the most are going to get it, hopefully. And in the market stuff, you don't know that. So, but it's a lot of housing, and a lot of low income people live in this housing. And I'm really concerned that we're going to lose both subsidized, because that's at risk, but especially the unsubsidized stuff. So let me wrap up with the policy stuff. And this is not all of my ideas, but I broke my rule for students of no more than 7 bullets. I think I have at least 8 major bullets here. I say. So the first thing is, the immediate crisis of millions of folks at risk of eviction. I don't want to downplay that at all. I didn't spend a lot of time on that because it's out there kind of much more visible than some of this other stuff. But the thing that I've noticed, there's an article in the New York Times today, really good article by Matt Goldstein, that said the current CDC eviction moratorium is playing out differently in different states. It's about who the judge is and what the state policymakers are doing to promote the policy, because the federal government generally doesn't get involved in landlord-tenant issues. It's not the way it works. So maybe we should change that in the long term, but in the medium term, we need to do a campaign that is about strengthening state and local tenant protections. The media, again, are based in DC and Washington and LA, 3 states. I wish DC was a state, but those are 3 places with pretty strong tenant protections, especially DC and New York. I mean, people in New York disagree with me, but come to Georgia. Vast majority of the states in this country have very weak tenant protections and have landlord-friendly law. And that has put, just think about, even if there were no mortgage moratoriums, foreclosure moratoriums, if you own a home and you pay late, the earliest you could be forced from your home would typically be 4 or 5 months. And in some states, it's a year. But even in Georgia, you don't even get a foreclosure notice for 3 months anywhere. No lender does that. In Georgia, the day after I don't pay the rent, I can see a foreclosure notice on filing on my door, and I could be forced out of my home in 3 weeks. It's just totally different in the tenant space, and we need to address that probably state by state. And I know that's kind of discouraging, but I think that's where that battle has to be fought. Secondly, overcrowding is clearly an issue with infectious disease. This goes back to the roots of planning, to the roots of housing, to Jacob Reece and Lawrence Vaylor, and what caused people to get involved around improving housing conditions. But the answer is not to deal with density. It's the opposite. Density isn't the issue, meaning units per acre. The problem is people per room and people per square foot. And the way to solve that is to build more housing, but importantly, it has to be affordable housing, because if it's not, people are going to double up. if the 2-bedroom apartment costs $2,300 a month, low-income people are going to put 2 families in that. And that's not good for infectious disease. This third point is one that I'm really concerned about. I've seen no mention of, and I may just be missing it. But I'm very concerned because of the understanding that overcrowding is a risk factor for infectious disease, for pandemics, that some exclusionary folk exclude low-income people from their suburbs, particularly, but maybe their neighborhoods, will seek to use occupancy laws more vigorously to basically exclude folks. And that will probably have a strong disparate impact, especially for immigrant communities, especially for very low-wage workers. And I understand we want to give those people more housing, but we don't want to say, okay, we don't want to go too far the other way, is what I'm saying, and make it too hard for lower income families to be able to live in certain places based on occupancy laws. The next thing that I feel very strongly about, because I just wrote a paper on this, is we need to think about our biggest supply side program on affordable housing, which is the low-income housing tax credit. And that program is particularly ill-suited for an economic shock because it bases the tenant's rent on a metropolitan median income, 60% of that income. It doesn't base the rent on the tenant's own income. So when the pandemic hit and people lost their jobs, HUD and public housing authorities were able to say, we will review your income and lower your rent, your portion of the rent, based on your new income, which might be 50% lower, right? LIHTC properties couldn't do that because their rents are fixed. And unless they have a bunch of cash sitting around, they can't just fill up that. Whereas in vouchers, the money came from the CARES Act and from the federal government to make up the increased gap between the market rent and a lower tenant income. In LIHTC, it basically puts the projects at risk if they would lower the rents. And so that's a real problem. And what we've seen in Atlanta in our work is LIHTC properties have eviction rates that are as high as market rate properties. And it seems to me, which in Atlanta are quite high, on the order of 15 per 100 units per year of eviction filings. And what we need is state housing finance authorities to basically incentivize developers to come up with ways to protect tenants during economic shocks, to have ties to rental assistance, to have ties to eviction prevention, to have connections to legal aid, which I know some of them will say, nope, I don't want to do that because the legal aid might sue me. But that's what needs to happen. We need to build in rental assistance to supply side subsidy. Big one that goes to the last 2 slides is we need, I know this is a tough one, we need flexible dollars for localities and nonprofits to acquire older rental properties for affordable housing. I just saw an Urban Institute and MacArthur Foundation paper that talked about preserving affordable housing, but it just went through all the existing federal programs and said, we need more LIHTC, we need more of this. I don't think LIHTC is the program for this. It's too slow. It's too expensive. It's not geared towards capturing older housing. It's geared towards building new housing. So we need, and I hate to bring up the neighborhood stabilization program because I was a critic of it, but we need at least money like that. I think it needs to be much more nimble than neighborhood stabilization was. It needs to be quicker. It needs to be put into the hands of nimble, capable nonprofits who are used to building and rehabbing affordable housing. The last 3 bullets I'll try to address quickly. One is before the pandemic, the Trump administration under Mark Calabria at the Federal Housing Finance Agency was on track to try to privatize Fannie Mae and Freddie Mac. This has been an idea that goes back during the Obama administration, there were Democrats and Republicans who basically were in favor of kind of semi-privatization. Calabria has been basically in favor of complete privatization. If we had privatized Fannie Mae and Freddie Mac, the footprint of the federal government in the mortgage market would be so much smaller. And instead of being able to instantly say, we are granting distressed borrowers 12 months of forbearance like they did, we would have seen people go into foreclosure. That would have driven property values down. That would have created more foreclosures, and we would have entered a vicious cycle like we saw in 2008. This has been a hidden success so far. I'm not sure it's going to bear out forever, but so far, the mortgage market has been a hidden success of how to deal with people under economic stress. The rental market has been the opposite. It's been a disaster. When people are put into forbearance, it's not only that they don't get evicted or foreclosed, it's that they don't have to pay. They do owe the money eventually, but it could be 20 years from now before they have to repay it. When tenants are under an eviction moratorium that lasts 3 months, they have to pay all that arrearage as soon as that moratorium ends. They're not going to be able to unless we get some serious rental assistance through Congress. And that's not looking very good right now. Finally, we need, when these forbearance programs on the mortgage side end, we need to be able to more nimbly deal with people who need to lower their mortgage payment. And that means fixing the servicing industry more than it has been fixed. I would say it's better than it was in 2008, but it's not great. And then finally, the FHA has a terrible history in terms of redlining and a variety of other things. But if it weren't for the FHA, the recovery, as slow as it was from the foreclosure crisis, would have been much worse. Meaning FHA in many neighborhoods was the only way to sell or buy a home in 2010. I did a paper where in many Black neighborhoods, FHA loans were 70% of the mortgage market. They're not that now, nor should there be, but they need to remain this kind of counter-cyclical source of mortgage credit. And the agency needs some serious kind of upgrading in terms of computers that aren't 40 years old and such. So that needs to be on the radar. I know this was a mouthful. I know it was lots of stuff, but I think it's all fairly important, and I'm looking forward to some questions.
Great. Thank you, Dan. We will go ahead and transition over to the discussion part of our talk today. The first question I wanted to raise with you is, you reflected upon the 2008 housing crisis. Are we on the precipice of another housing shock that was as severe as what we saw in 2008 in regards to the number of households destabilized?
That's a great question. I think in terms of the number of households destabilized, it could be worse, right? There's different kind of outcomes and measures. And in terms of folks displaced from their units, I think this potential eviction crisis, which I'm not convinced we're going to be able to measure very well in terms of how many people are actually being displaced because of self-help evictions. And, the current moratorium only covers people who can't pay the rent. So there's already stories of people being evicted for other causes, which might be made up, right? It's not clear the courts can handle this right now because half of them are not operating very well. So I fear on the displacement question, the physical displacement could be much worse. On the wealth question, I think we're in much better shape because of how the mortgage situation has been handled. Now, if we have a problem with foreclosures and people losing their homes that way, I think that's going to happen 6 months now, more like 9 months from now. Okay. And that's why I think it's really important who runs the government to deal with that, and that we keep the Fannie Mae and Freddie Mac public, is essentially public. But on the displacement thing, I know that particularly right now, one thing the moratorium doesn't cover right now is extended stay motels. It's explicitly exempted. And in Atlanta, that's a huge source of affordable housing. This is housing often used for the folks who have evictions on their records and have real trouble getting housing otherwise. People who can't save enough for a deposit, right? Because these motels don't require deposits, most of them. So it's to some degree the hardest to house population and the most vulnerable, and they're not protected. So we've already seen anecdotes, and they're often, they don't really, if the tenants haven't been there for 90 days, they don't need to go through the eviction process. They can just lock them out. The tenants who are there 90 days, generally they're supposed to go through the eviction process. It's not even clear if they're complying with the law. So I lose sleep at night over the displacement question.
And you raise a very important point about the connection between housing instability and overcrowding within the units. And this is something I think in the public health circles, there's some recognition of, but not a true recognition of how much worse this could get if housing conditions grow more challenging. Could you see if more renters are evicted, we see more overcrowding? Could that actually extend or worsen the pandemic?
Exactly. No, it's people say, well, you don't want people in homeless shelters and you don't want people on the street during pandemic. That's the most obvious, but that's probably not where most people will end up, right? After a week, they will end up doubled up, and they may have trouble finding people to double up with because people are scared of overcrowding, rightfully so. I mean, it's a real risk, but I definitely, this is an area where I draw on my better half. My wife is an MD infectious disease specialist, and she studies housing and health to some degree. And she's very concerned about doubling up and worsening right during virus season, right? Right during the winter could be the time. And then adding the flu on top of that and low vaccination rates, it's definitely worrisome.
Your talk really exemplifies the connection between the housing market and the economy, but also the state of our nation's health. The question I have, again, reflecting on 2008, I felt like we had some more immediate response. You mentioned the neighborhood stabilization program at that federal level. Where is that federal leadership now? An agency I don't hear enough about is HUD.
It's amazing. The bright spot again has been the forbearance on the mortgages, and that came out of HUD was kind of kicking and screaming going into that. They were the last ones to grant forbearance. To his credit, and I often disagree with him, especially on the privatization issue, Director Calabria did move fairly quickly, and then Congress followed. But I think the GSEs, they want to arrest the spiral downward of property values because they will lose a lot of money, and they will, be embarrassed politically when they have to go to Treasury to get money. So I think that's a huge problem. But in terms of HUD's response and Congress's response, it's just been abysmal. It's kind of interesting that the only thing that's done right was, kind of done by the private sector almost, or the quasi-private sector. Government has been kind of, other than CARES, and certainly the recent state and local governments, some with state moratorium on evictions, some have come up with a little bit of money, but most of the money they're using seems to be CARES Act money. Yeah, HUD has been nowhere. I really haven't seen them. It's pretty amazing.
I want to open up the opportunity for some of our questions that we've taken online. Professor Motoyama, do you have any questions you'd like to interject into the discussion?
Yes, we got several questions. First, it's a comment, but Alex, thank you very much for your comment and agreeing with Dan's presentation on data. First question is from Dorothee Imbert, our Knowlton's director. I think she's referring to one of the early figures, I think a slide 5, where you had the types of units and race and ethnicity breakdown. Isn't white and Asian too broad of a category? So I might like to add, is there a breakdown between the white and Asians, or do they have a very similar pattern so far?
That it's a good question. I took that from the Urban Institute study, so I wasn't able to break it out. So I actually don't know the answer to that. I do know in mortgage patterns, particularly because I do a lot of work with mortgage, when you break out Asians, you get very disparate activity, meaning, kind of particularly Pacific Islanders look quite different than other Asians, and that may be how long folks have been in the country on average, stories of immigration. But I wasn't able to break that out. That would be an excellent question to know.
Absolutely.
Thank you. The next question or comment comes from Gala, and she's pointing out that Ohio State University has the Buckeye Village, which is the family housing, but that's the only family housing left for now for graduate students. Even before the COVID crisis, the university decided they are going to close this graduate family housing unit. I'd like to add a question. Do you have any insights about the students or the students with the families at this point?
No, that's a really good, excellent question. It's not on the same track, but student housing has become, I think, an issue during the pandemic generally. We had a bit of a scandal here in Georgia in that a few years ago, our universities were allowed to essentially privatize student housing, to sell it off essentially, or at least lease it to private companies. And in their agreements with the universities, they obtained some control of policies that governed occupancy levels. So when the pandemic hit, they basically lobbied the universities, this one company in particular, lobbied the universities to basically go face to face and maintain high levels of occupancy in these dorms that they were running, because if they didn't, their revenues would suffer and their bondholders might come after them. So we found out that privatization of student housing could have some real, this is basically a type of financialization, could really lose, basically the public sector, these are public universities, gave up control over something that affects the public health of the university. And I would argue in Georgia, the public health of local communities, because some of the highest case COVID counties in the country are university counties in Georgia, because they're small towns where the university makes a huge difference. And so when COVID spikes in those towns, the whole town is affected. And so privatizing housing becomes not just a university policy, but a public policy.
Thank you. Two more questions. Jake is asking, if banks walk away from lower rent properties, at what point does allowing for squatting become a legitimate urban policy?
I didn't get the end of that, Yaz.
Okay. Yeah. At what point does allowing for squatting become a legitimate urban policy?
Interesting. And that's reminiscent of some campaigns in California to allow basically folks who were evicted from housing that was then left vacant to at least go back in that housing, because it was basically a speculative purchase. That's a very good question. I know in many cities during the foreclosure crisis, we had, very high vacancy rates. Many cities still have very high vacancy rates that really stem from the foreclosure crisis. But I think it's important to have strong policies, local policies, state policies in place to allow local government to basically acquire those properties. And that means strong code enforcement on vacant properties. We have a problem here where older homeowners are being kind of forced to sell their homes because code enforcement is attacking them. I think that's a terrible thing. But if code enforcement is applied to speculative and vacant properties, those properties eventually can be acquired by local land banks and then converted sold at low cost or no cost to nonprofit housing organizations or to community land trusts. But you have to have the mechanisms to acquire those properties. I have no problem with squatting. I mean, there's been Margie Dewar at University of Michigan did some great work during the foreclosure crisis on essentially squatting in Detroit. But you had a government there that was just not capable of enforcing property laws. And I'm not saying that was a bad thing. I think the squatting was fine. People just kind of acquired the lots next to them. But in most places, that's not a secure way to provide housing, right? It's not going to create stable housing to just squat. I want people to know where they're going to live a year from now if they want to. And to do that, we need to acquire vacant housing, to acquire tax delinquent housing when the owners are abandoning it.
Thank you. The last question at this moment comes from Ariel. To your point that most of the media is based in large cities, how does the housing data from rural communities compare to urban and suburban?
That's a really good question. And I am more an expert on the urban side than on the rural side. But a lot of people say, well, housing affordability is really an issue for cities and for big cities and expensive cities. And there's no affordable housing problem in those places where rent is only $800 a month. Well, it turns out, like in my state, for example, if you look at county level data, we have a lot of counties in Georgia, 159, and you look at county level data on the percent of folks who are paying more than 50% of their income in rent, the worst counties are rural counties because incomes are very low. So what's affordable in metropolitan Atlanta is not at all, it's a different world in southern Georgia, in rural Georgia. And that doesn't mean it's not a problem at all. It's at least as big of a problem. And I really do think that this abandonment issue could be a rural problem as well. Because when rents get down to, let's say normally they're $500 a month in a rural community, and all of a sudden, 30% of people can't pay their rent, it's not like rents can just drop. There is a minimum rent at which a landlord just will walk away from a property. Alan Malik has written about this. It affects cities too. If you go below a certain rent in terms of what the kind of market will bear, and people don't have the money to spend $600 a month or $500 a month in rent, it's not worth it for the investors. So they will abandon the property. And that is a role for local government and nonprofits, no doubt about it, but they need some money.
Well, yes, do we have any more questions?
No, that's all for now. Thank you. Thank you very much, Dan and Jason.
Thank you, yes.
Well, we're closing in on the 1 hour mark. I guess I, as moderator, just have one more question for you.
Sure.
You know, in terms of federal response going forward and local response, what should folks who work in urban policy, housing policy, city planning, what should we be advocating for?
The easy answer in the short run is serious money for rental assistance, right? Because that, and I want that money to go to tenants, or at least under control of tenants. And we can leverage that with getting landlords to accept basically a haircut, saying, let's say they're owed, $2,000 in rent. Well, if they're willing to, lower it to $1,500, the rental assistance program will pay them, right? So we need programs like that. We need them run well. I really wish we could, get $100 billion or $150 billion from the federal government, but I think that's only going to happen if something, if the politics change at the federal level dramatically. On the kind of longer term kind of securing property, I do think there's lots of possibilities. I think one good thing about property values kind of stabilizing is when the crisis first hit, the municipal bond market kind of froze. And cities couldn't raise money because people didn't know what was going to go on with the tax base. And a lot of municipal bonds are paid back through property taxes. And so right before the crisis, the city of Atlanta was about to announce a $200 million bond, or maybe $100 million affordable housing bond, to acquire land, to acquire property. And then the crisis hit and everyone said, oh, game's off. Well, a couple months later, and I would say that the Federal Reserve helped in this way. And the Federal Reserve basically, even though it hasn't been used much, they did at least say, look, if the bond market doesn't come back, we'll provide that financing. But what I'd really like them to do is to provide that financing at 1% for 30 years. And they can. And that would really allow cities, because right now, if the city of Atlanta does a bond, it's probably, a 4% interest rate. If you could do a long-term 20-year, 30-year bond for 1%, it would at least double your spending power and your acquisition power. And I think we're in a position with the Federal Reserve's backing that cities can do this. And I'm not seeing many cities do it. Yeah. Now, obviously, they're under stress, but this is a long-term investment. If the city could get 1 or 2% money, it would be a very small portion. The interest and principal on that would be a very small portion of their budget. And it's kind of a federal local partnership, but that I think could be a real, and then the federal government can definitely step in with all kinds of resources, kind of like neighborhood stabilization, but not through the CDBG program, not through the paperwork, use more like what NSP2 was, except quicker. Use high capacity national nonprofits and local nonprofits, have them propose how they're going to spend the money, give them the money, have some local oversight, but get the money out, because you're competing with private investors. And, NSP1 was just way too slow. And by the time the money hit the streets, all the good homes were gone. They were all bought by private investors.
Great. Well, thank you. With that, we're going to close our lecture for tonight. I wanted to say thank you, Dan, for such a just a robust and compelling view of the housing market, and chilling when we look at some of the data measures and metrics that you showed us tonight. And also, I think a very powerful set of policy recommendations that certainly I'm going to be thinking more about, and definitely we'll be talking to our students about as well. So I want to say thank you for sharing your great expertise with us tonight. And thank you to all of our viewers for tonight's Baumer Lecture.
Thank you, Jason and Yaz.
was great.
Thank you.